So one of the questions that I wanted to put to everybody on the panel was to tell me what, and all of us, what you've seen in terms of an uptick, if you have seen one, in interest in this climate solutions, low carbon investment space, let's say in the last 5 years, and then more specifically in the last year. Val, can you comment on that?
Sure. So speaking generally first and looking at the 5+ year time horizon, so I'll frame this against a goal that we announced a year ago that we met early. In 2007, Citi announced a $50 billion climate finance initiative, which was a target to do $50 billion worth of business with our clients and to facilitate $50 billion in financing of low carbon, whether it's renewable energy or energy efficiency, but climate positive solutions that our clients are in the business of doing. And we announced that goal in early 2007. About a year later, the financial crisis hit, and we immediately, well, we were panicked for a number of reasons. And my team was panicked because we had set forward this public goal that, that all of a sudden seemed to be out of reach. So I guess the first lesson is in the power of setting longer term goals so you have enough time for the bumpiness. But I think the second lesson was that we saw the market for low carbon projects and finance take off in a way that our bankers didn't really expect. So we announced at the end of 2013 that we had hit the target 3 years early. And I will say that's not even with complete accounting. We sort of did a, lowest hanging fruit, gathered the big chunks of activity that we had helped our clients to do, counted it, reported it on an annual basis, hit the goal 3 years early, and in a week and a half, we'll be announcing a whole set of new sustainability goals across our different areas of activity and business activity. So I think we've seen a tremendous amount of activity in the past 5 years. I think in the past year, we're seeing a little bit more comfort with some innovations around finance. I think we've talked a lot about green bonds at this conference, and the green bond principles were only announced a year ago in January of 2014. And it's been pretty amazing both to see the amount of excitement that green bonds and SRI bonds are now generating, but also to see the sort of rush of intellectual capital to figure out how to make these environmental and social impact bonds really work for the issuers, work for the underwriters, work for the investors. And we're also seeing, there was previously a discussion of sort of the power of securitization. And we are seeing, I think, little small points of light on that as well. We've been working for the past couple of years to establish energy efficiency as an asset that can be securitized, that can be sold to investors. So we have two particular projects we've worked on in the United States, platforms. One is called the Warehouse for Energy Efficiency Loans. The other is called Kilowatt, that basically support loans to homeowners who then make energy efficiency improvements. And the goal is to sort of aggregate those from different states, different houses, into a securitized thing that we can then use. And we're expecting by the end of Q2 to have the first securitization of energy efficiency. So I think when you look at sort of the amount of innovation that's still able to happen in the market, we feel like the past year has been pretty monumental in terms of where we could actually go in climate finance.
I want to make that a little more concrete. Normally, Val would have a chart up here where you would see this curve, so you have to picture the curve. But if memory serves, the green bond market, if you go back to 3 years back, came to totaled around $3 billion. And 2 years ago, it was 13, and last year it was 39. And the discussion this year is, will it double or more than double? So it's a very exciting time in that market. Now, one of the questions that's come up about that market is that as we've discussed earlier, the terms, the structure of what constitutes a green bond is by definition and intention very soft and open. And the green bond principles don't restrict that, they don't define it. They encourage investors and interested parties like ICCR to bring forward metrics and refine and develop different categories of bond instruments. And we're going to see some of that work. I've been working with a task force at the Alliance to Save Energy, which is rolling out, actually to the Green Bond Principles Board, an idea called carbon counts, which is a metric that would allow an investor to see in a very direct and quantified way the level of CO2 emissions reductions per $1,000 of bond value for bonds that are being issued in the U.S. And it's a very interesting step to help quantify the kinds of impact these investments can have over time, and I think will give investors an idea that now they can begin to tease apart what green means to them and focus on the elements that matter most from their perspective. Anybody else comments on that?
Yeah, I think one of the things that I think I've had a couple of different experiences, a few different experiences that kind of stick out in my mind in terms of kind of the growth of the last year or so is, I think generally, mostly it's been us talking to clients or potential clients about what's out there and then seeing the surprise on their face knowing that some of these things are actually available in the fixed income market, because most of them would have thought of the fixed income market as kind of a sleepy corner where you couldn't do a whole lot, and where and the stock side is the exciting part where you can do lots of amazing things, which it is true, but really there's great things that you can do on both sides. I had a call a few months ago. I think this was supposed to have gone to Mark, but I think maybe he was out of the office or something. I was like the third backup or something like that. And so the guy, and I hope he's not in the room, I don't actually remember what his name was, because someone asked me later on, well, who was it? And I said, I don't even know. I didn't get it, because right away he was like, do you guys have fossil fuel free portfolios? And I said, well, there's a little explanation that can go along here, and that we don't have our mutual fund is not specifically fossil fuel free. So at this point we have about 75 basis points in the underground 200, and he's like, hold on. Do you have any funds that are fossil fuel free? And I said, well, actually we're also doing positive investments that we feel like, and he said, no. Do you have fossil fuel free funds? I said, well, no, I guess we don't. Click. And I thought, oh, well, I mean, okay, I understand that there's boxes that need to be checked, and that's important. But I also think that there's context around some of these things that can also be important. And so I think there's some very, very important growth that's occurred in the market in terms of kind of the advisor community or the client community in terms of understanding what's out there, what's available, and I'm sure there's lots and lots of education from different managers on the fixed income side and on the equity side that will be taking place. I'm just hopeful that we can continue to have more robust discussions than can you check off this box, and if not, then we don't really care. So,
terrific. Thank you.